We have just witnessed something that we've only seen 4 times in history, a sell-off so brutal that it sent the VIX up to 65. But what does the data tell us happens next? And more importantly, how important are charts like this to hold their key zones? Today, we talk about what just happened on the stock markets around the world, why the Nikkei going up 7% is kind of a good thing, and whether we saw the number one recession indicator flash red for a brief moment in the last session. Stocks, commodities, and cryptos coming your way right now, guys. This will be a great one. Let's talk about it. Well, welcome back, everyone, to what was a historic day on markets, a sea of red crashing across the board, and of course, trillions of dollars that were moving around. If you managed to catch our open show, thank you so much for making that one of the biggest we've ever done. And also congratulations for being able to figure out that semiconductors held the key. Holding that 200 zone was such a big level for the markets. And in today's video, we'll explain that along with what's really happening with the data and of course what we expect to happen next. But it was extreme fear that really showed itself in the market. Capitulation across the board like we haven't seen really almost ever in markets. And this was certainly reminiscent of the 87 flash crash known as Black Monday, where literally portfolio insurance cascades went out of control and it sent the VIX almost to 100 in just that event. We have now seen 4 of these: the global financial crisis, the COVID lockdowns, and what is being dubbed at this point the yen carry trade unwind, or as I like to think of it, as margin unwind across the day, basically I think driven by zero DTEs. The Nikkei also suffered the same fate, the highest volatility on their index since the global financial crisis, and we have some interesting stats surrounding all of this coming up. But did you know that even if we closed at 38.57, which is pretty much where the VIX did end up closing, according to Charlie Bilio, that is actually the second highest change in the VIX since the 1990s, so basically 30 plus years. And really, we know we hit a 65 during that session. So imagine if the VIX had held up. Realistically, it's the largest overall percentage change that we've seen since 2018. And it kind of is reminiscent of the market having a real freak out. That's what the market did. It had a real freak out, and now we need to determine whether that's real for us as investors and traders. Do we need to be worried about a recession, an impending recession? Did the chart suggest that everything's going to melt down and blow up? Well, let's have a look at it together in today's video. But first up, this was incredibly rare. I mean, we just do not see this. Days since the last 3% down move. We can now reset this particular indicator, but as you'll notice, generally speaking, you have to wait usually 300 to even thousands of days in between the overall market going to 3% down in a session. So it was definitely a historic day across those standards. Mike Zaccardi sharing a couple of other sentiment reports I thought were worthy. The Twitter economic sentiment is still quite bullish across the board, and this one here was really what we were looking at the most coming into the open session. We brought it up several times in our open chart stream. I encourage you to go check that out on the channel if you have subscribed, and make sure to have a look at what this really was telling us. Basically, this was the VIX telling us as of Friday, by the way, so therefore Monday became even better, that the market had likely hit a short-term low. Now, when you tend to see these events, and this thing would have been flatlining by the end of the session there, you'll notice that we often do get capitulation fear. And that's exactly what we ended up seeing. It was so fearful, though, that things like the NASDAQ were actually down 6% on the session, which is just unfathomable outside of a complete global meltdown, which basically would usually mean the world, or at least the economics of the world, are really weakening massively, which we don't really necessarily see the evidence of yet. We've obviously got significant weakness, but not enough to say, wow, everything's at the end at this point. So it does look like it's a tantrum. Now we need to put it back into perspective. Is this something that we usually see? Well, here are the general moves per year for S&P 500, and you'll notice that you generally get 2 sell-offs per year in the vicinity of 5 to 10%, something we've talked about a lot on this channel, and they're usually the good pullbacks to get in if you believe there's continuous bull run. We are now sitting at around 8% down overall on the S&P, and of course we're sitting at a lot more than that in terms of correction territory on the NASDAQ. And the NASDAQ's probably where the best opportunity is here if you believe in the market. 8% year to down. Now, this is something that we need to talk about because, of course, that stat of 8% will come up later on with some amazing data. And we also know that these huge historic moves generally bring some interesting stats over the next 1 year. In particular, the Japan 225, the Nikkei, you can see here when it has massive freakouts such as 12.4%, which is historic in itself, we do usually have an overall 1 year result that is bullish. In fact, that has a 100% track record when big sell-offs like this have occurred. So this is an interesting one because even during the global financial crisis meltdown, over the next year, there was all sorts of up, down, and all around, but the market still ended up being bullish. It's usually associated with near the end of the sell-off, not necessarily near the beginning of a sell-off. And that, I think, is a big point here. What about the VIX spike? Well, Charlie Bilio here has another interesting stat. 88% of the time, 1 year later, we are positive. Generally speaking, the market is actually overall very, very positive when it comes to seeing these kind of freakouts by the VIX. But remember, this was again data taken as of Friday. So that was a lot higher as of the Monday close and during the Monday session. And what that's again kind of leaning into here is that we saw some kind of historic flash crash style scenario, which has now been bought up by at least algorithms and what we'd have to assume is going to now be bought up by dark pools and CTAs, which of course will be on the lookout here on the channel together. So make sure to subscribe for that because CTAs and dark pool activity will end up really proving whether this rally or at least this pickup is real or not. What about Goldman Sachs? Well, Goldman Sachs believe that the recession is possible, but still not probable. They've marked up 25% chance of an overall recession over the next 12 months. And while we have to take that with a grain of salt, we will be looking at a lead indicator that started to flash a little red as of the last session. Of course, that is yield uninversion. Now, something I've been requested a lot of, you guys over on X, follow us in the links in the description down below, we're saying, what is the ratio? Is everything cheap now? Is it cheap or is it expensive? Well, the Russell 2000 price to book ratio is now kind of sitting around the average historical mean. So we're back to a more fair price. And of course, the big one that everyone wants to know is, are the big tech stocks cheap yet? Well, they're not cheap, but they're coming back down. They're actually very close. The low here, they went to the 10-year median almost of 24x. So are they expensive? Yeah, but they're certainly not as expensive as they were. So remember, they've been living up to expectations. So even though they're at higher points, by forward PE metrics, which is what most of these are valued at, we ended up going within 3x of where the 10-year median is. So it wasn't too bad a buying opportunity if you were brave enough to pick up that dip. S&P 500 returns following 5% pullbacks. Here's another interesting fact. Of course, in general, markets do rally. It's not really hard to note that the next 1 month, 3 month, and 6 months are generally quite positive. Although I do find it interesting that over the next 12 months, when you get these kind of more dippy periods, sometimes things can get a little bit wild when it comes to overall percentages. So it doesn't necessarily hold true that everything is great 12 months later. It just usually does recover fairly quickly. Now let's talk about the big one though, because this is of course the discussion point. How many basis points will the Federal Reserve cut? How much will they cut over the next 6 to 12 months? And what does it mean for us in terms of navigating this market moving forward? Well, we do have to expect that JP Morgan might be correct with a 50 basis point cut. I'd like to see the Fed maybe even cut less because it could mean that there is an impending recession. Remember, the faster they cut, often the more freaked out they are in the markets, as you'll see in a moment. And currently we have 135 basis points of cuts predicted and priced into January 2025. Here are the two scenarios that are most likely that we brought up in our last video. Usually 1 to 2 months out, we have a tantrum, the market freaks out, and then we get a cut, and then we usually sell off a little bit after the cut period, and then we go in two directions. We either go super bullish and things turn out good, this is in a non-recessionary period, or in a recessionary period, everything goes bad and it's the end of the market. Now, which one do you believe it is? Pause the video here and put it in the comments down below. I'd be very interested to know what you guys, or what we all think together, is going to happen next. Because yeah, this is a very important pivotal point. When the Fed cuts, is it just a nice cut to kind of, secure the economy and make it better? Or is it going to be a cut that ends up being because there's a recession on the horizon? Let's take a look at this for the data stats. Now, 8%, as I mentioned before, it's a very important number because 2 months before cuts come, even in non-recessionary markets such as the 1970s or even in 1998, which was, by the way, a concentrated tech boom that led into another couple of years of run before the crash. And I think that's very important. It continued to run up before it ended up crashing. And notice also when the date was as well, September. Yeah, very interesting there. But either way, we went negative 8% 3 months out, negative 7% 2 months out, and then we ended up having, of course, the weakness after the first cut, and then we went into a very, very strong market. And in both situations where we went negative 8 early, we ended up in very strong markets 12 months later. And I think that is an interesting factor here that we need to consider. Weakness here, which is basically in August, then weakness, which would be effectively October, into strength. And I think that is a very interesting stat indeed if price action does come with that data. Here are some other ways of looking at cuts. Notice the 50 basis point cut, the orderly basis point cuts, the ones that are more supportive of the economy, 2019, 1998, for example, and 1995. All of those came with pretty good overall 1 and 2 year returns. Of course, the 1998 one led into a horror crash, which is what I suspect is going to come. And then we've got the 2007 and 2001, both had 50 basis point cuts. And I think this is the important factor here. 50 basis points versus 25 basis points. They were freaking out and they were cutting hard. And they cut hard and they cut hard, and it led into, of course, yes, we were actually in a recession or we were in a bubble that was blowing up. And this is a huge factor. So do you think it's going to be 50 basis points or 25? Another interesting comment down below would be good there. Now, you've probably seen this chart going around a bit, the apocalypse in terms of what happens if the market is going into a recession. Well, yeah, this is how bad it would actually be in terms of, generally speaking, you would see a lot of big pullbacks if we were going into recession. But I'm going to fix this chart for you guys. If we went into a recession right now, considering how bubbly the market is in general, I believe it's going to be one of these style scenarios. And what that means is basically it'd be a 50% wipe off of the market. Now, I don't think it's right now. We've been talking about this a little bit. We pretty much think, based on a chart coming up soon, that it could be more in the future, maybe 12 to 18 months away. But yeah, that is going to be how bad it will be. Eventually, we're going to unwind this market and get back into one of those 15, 14, or even 13 style X markets. And it just is the way that cycles and stuff tend to actually play out. If you ever want to find out more about why this is, and it will be driven by debt, believe me, then check it out on the advanced masterclass, fxevolution.com. You will be absolutely blown away by the data that is presented there and how we constantly make the same mistakes. It's actually a political system, and when you notice it, you'll be like, wow, I wish I knew this earlier. Let's talk about VIX futures in terms of term structure. We still expect, of course, volatility to come in, although I would say that is a high lock for August. So we have high locked the VIX. The chance of going back above 65 is very low, and it would take a cataclysm basically to push above here. So we've high locked the VIX, the month that you usually would lock it, either August or October, and I very much doubt that the VIX is going any higher than 65. So that will be a high lock. That will be the highest the VIX goes, in my opinion. Let's move over to one of the charts we shared over on X. Just one of the reasons why I think you guys definitely should follow us there. We do post a bunch of charts during the intra-session. And you'll notice here that these were two of the key levels we thought in the crypto market. Now, Bitcoin ended up going to about 49, but these were both spectacular levels. Remember, I told you that the markets, they're synced together. We know this. And this actually led into silver hitting, crypto hitting, the semiconductors hitting. We also saw the NASDAQ and the S&P coming to very interesting levels, not quite hitting perfect zones, which you'll see in a moment, but there was so much syncing up around the markets. Does this make sense to the presidential cycle? I'd say you can probably chuck this one a little bit out. Yeah, we do tend to see a little bit of weakness around here and then strength, but yeah, this was certainly a very unusual period. We are still in earnings season, though. I don't think this is the main thing the market's thinking about. But if you are trading earnings, please be aware there are some incredibly volatile events coming. Reddit, plus minus 20%. Supermicro, plus minus 15% expected by the options market. Shop, DDOG, TTD. This is the week of hyper growth stocks, and they will be volatile events. So just remember, there will be billions of dollars floating up, down, and all around there. During times like this, I also think it's best that we don't lose sight of one of the best reads that you tend to see on markets. Now, it's never been wrong yet. So I always bring it up every video just so we can kind of step back here, and I'll just bring that up. And that's the Whaley breadth thrust. You've got to remember it generally does bring weakness over the first couple of weeks. And remember, we saw this around 2.5 weeks ago. We have seen a very strong 12 or 9 month kind of run here, even when we had weakness over the next kind of 3-week period. So it's expected to be weak. We have a 50-50 market about 2 weeks later. Then we tend to go more bullish and more bullish and more bullish. Now, this still has to be the base case unless something changes, because this plus the 770 thrust are still very important indicators on the markets. Now, you may have noticed we had this quick bit of note here from Mike Siccardi about Apple. Apple obviously getting sold off by Warren Buffett, 49% stake of sale of Apple in Q2. And they're basically saying, we don't care about Warren Buffett getting rid of it. We still believe in Apple, and we still think that the stock is going to do quite well. Pause the video if you're interested in reading that one. I thought I'd include it. And if you like that type of stuff, let me know as well. Now let's talk about secular bull markets. This looks very reminiscent of a flash crash that we saw back over here. And of course, yeah, it's kind of saying to us that this is kind of what we've got right now. Then if we see this, then we keep going possibly. And I don't think we're going to run 1,340 or even maybe we'll just run 1,000 or even less days. So somewhere here in 25, 26 is where I think the big problem is going to be for markets. Now, we don't know that, but of course we can speculate that this is more than likely, as we have been tracking it relatively well over the last couple of years. And this brings up a very interesting point. If this market does end up making a new all-time high over the next few months, I want everyone out there, we all have to remember, and I said this in the stream, do not ever forget what you have witnessed here today, because this is a wild market session. It needs to be remembered, and it shows you the fragility of this market. If the market goes on to make all-time highs and everything goes, oh, fantastic and everything, even if we go up another 20 or 30 or even 40%, this is basically showing us right here, right now, that we are in late cycle investing. This market is sick. This market is disgusting and is being driven by overvaluation. That is how fast we hit a 65 VIX on a freak out in the market. So remember, if it does make up a new high, yeah, we're still late cycle investing, and therefore we still think utilities, gold, and of course, if you want to follow the bubble in AI, they're really some of the biggest sectors that you need to be watching. Let's now move over to the S&P 500. Of course, the S&P 500 did drop in terms of overall advanced decline here. You can see we did see declining stocks across the board, not to be unexpected considering how much the sell-off was. We didn't end up down in the 50-50s during this session because we opened up actually quite strong. The market went bullish straight into the open. The last kind of 10-15 minutes really found that bid. We ended up as a long leg doji. So really, we ended up as an indecision candle on the main market day. That is the SPX or the SPY. Let's have a look at the futures though, because the futures paint a very different picture. Now, one of the things we were doing live on the show was we were trying to figure out where this thing would bottom off. And we ended up coming up with 50-55 and the daily 200 moving average and the anchored VWAP. And all of these were corresponding into this green box zone. And along with semiconductors, it helped us to really ascertain an incredible level that we believed we were finding on the markets. Not only was it the most traded zone on the way up, but it was also quite a lot of good things, including the daily 200. And in the next video, we'll talk about the importance of the daily 200, because if the daily 200 is taken and it is goes below it, there is an incredibly good chance that we will rally back to that level, and then the market will make a valid decision on whether it's truly really a bad market or not. Daily 200s cannot be underestimated. We'll check it out in our next video as we break it down together. Let's go to the 2 hour though to see what actually happened here, because market structure did improve through the session. We saw an initial wick buy. We saw a breakthrough of 52.50, which we speculated was a fairly large turn event by the markets in terms of the small time frames. And you'll notice here, effectively, it's put in what we call an inverse head and shoulder pattern. Now, an inverse head and shoulder pattern should theoretically go the distance of the head to the neckline, so we can actually extrapolate this out. The reason we're doing all of this is because what we want to know is whether that makes sense to maybe something like a volume profile. So if we grab a volume profile on the way down, you might notice that there are two heavily traded zones. There's a heavily traded zone around 5,300, which just so happens to be the weekly 20 moving average, mean reversion. that will probably act as some form of bear pressure over the next 24 hours if we do hit it. So this is currently what is a possibility here in the markets. And if we go to 5,400, there's actually quite a lot of trade that's gone through it around that mark. So 54 and 53 are both key levels over the next 24 hours. The markets seem to have found some resilience here. And one of the things that you can really mark out as well is around 5,200, it seems to be there is a buyer there. So the buyers seem to be there and the sellers are most likely at 5,300 and at 5,400. Now, does that make sense to the options market? Let's have a look at the options market. And this is what we find. Negative gamma, negative gamma, negative gamma. Now, so many big funds were caught offside yesterday. They were having a hedge with futures. It caused a cataclysmic event. Effectively, we saw it in the options world, and we still are in a negative gamma world. So at the time of this recording, spot price 51.86, give or take, to 5,200 on the markets plus at this stage. And that means that we are above things like the 5,100 puts here, but we still have a lot of puts over the next session, all the way up to 53.45. Now, if markets stay low, then we are in a negative gamma situation. So that's going to keep pushing that negative narrative. So even though the future structure has improved, we still do have some options problems. So yeah, it'll be an interesting one. Price action versus the bears. And I would generally think that when we see rallies, there could be still some sell-off at those events, the 5,300, the 5,400. And we do need to remember that there are probably still a lot of hedge funds that are caught off guard, needing to, in this case, or not hedge fund riders, basically, that need to actually hedge their positions. The next session is similar, negative gamma, and we will not return back into a positive gamma situation until we get really above 53.50. So something to be watching. Let's now have a look at CTAs. Gold CTAs dropped a little bit, but overall the price for gold was very good. S&P 500, as we expected, plummeted on the CTAs. We'd expect updates on this to continue to show massive fall-offs, and NASDAQ also falling. We will have updates on the CTAs. I think we will have seen a buy over the last 24 hours on them, but remember, it is delayed by a few sessions, so we'll get that as soon as we can. Copper CTAs, not too much going on there, still not really purchasing up, and Brent still not purchasing up, although Brent did hit the mega level for buying. So Brent is now on the super support. Will it actually find a bid? It started to over the last 24 hours and actually almost is presenting a day trade as of the time of this recording. Tesla, we talked about 188 in our last session. We actually ended up getting lower than that. A few of you guys in the live were pretty happy with yourself with your 180 something buys. Rightfully so. It went to 199 by the end of the day. Congratulations if you managed to get that. And it's back right on its put level. And of course, it's trying to figure out whether it's going to go up and turn into a positive gamma or negative gamma. 200, a strike to watch, and then 220 if we keep rallying up. That's going to be where the hard kind of ceiling is for now. And we'll look at the structure of Tesla in a moment. Let's move over to NVIDIA, probably the most important stock in the market. And it came back big time. Opened in the 90s, low 92, 91. Rally. Semiconductors held such an important zone that we'll talk about. And we managed to hold that 100 zone pretty much near the end of the session, which again is where all the puts sit over this week. 115 topping, 100 base. So just before we jump into the charts and we take a look at all the key levels that we should be watching, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, if you're from Australia or even from other places around the world, Tiger Brokers could be one of the options for you. And over the last 24 hours, it's become more important to have a broker like Tiger when it comes to trading these markets. Having the access to the futures is very important. And of course, Tiger Brokers have not only got 24/5 US stock trading for Australian viewers and also other people around the world, but they have very cheap fees. And they wanted me to tell you guys that they've actually reduced their fees across the board. Minimum now for Australian $2.99 per order on ASX stocks and $1.99 per order on the US stocks. And if you know anything about Australian prices, this is a very good deal. If you're interested in finding out more about Tiger Brokers, please click in the links in the description down below. And remember, guys, I've managed to secure you an additional couple of bonuses. If you open an account, fund it with 2,000 Australian dollars, and you'll get US $30 worth of Tesla and, of course, an additional $30 cash voucher as well. They've won tons of awards, so check them out. Links in the description. So let's take a look at whether the charts are presenting a bullish or bearish case scenario right now. First up, S&P 500 versus central bank indicators. And we see the world central banks injecting pretty hard over this drop across the world. And even the Fed started a little uptick over the last 24 hours. I would say the weekly will be important there. Next up, the VIX. And this was a monumental day. 65 on the VIX is just something you don't see very often, and is highly likely that is the topping point for the VIX during this particular capitulation cycle. It's very difficult to get it up here, and this is something that you just don't see. I've seen it 2 other times in my trading career, during 2020, and of course when I started during the global financial crisis, and it's just so rare that it had me almost thinking, whoa, this is just monumental. Now, with the VIX this high, what does that tell us? Well, we've probably seen a capitulation low. That doesn't mean, though, that the market sell-off is completely over. It could theoretically bottom out even more, though I would say that would be so negative towards the markets when we look at semiconductors. Semiconductors had to hold over the last 24 hours, and they managed to do so. Another chart that I want to ask you guys, have we actually uninverted the yield curve? Now, yes, I know if I zoom this in, this is the 2-year versus the 10-year, we'll notice that it went just under 1%. I don't even know if it counts, I asked you guys over on X, and most people thought, I don't think it counts because it didn't go down there for long. Look, it technically uninverted. I would say probably should hold down there for a couple of days to really prove an uninversion. So I'm going to call that a technical glitch caused by my charts being wrong. Either way, of course, uninversion of yield curve generally puts us on a recession timer, and our expectations are 3 to 12 months after that uninverts, we will see the recession come through for the US. So was that the real one? Are we 3 to 12 months away now? Are we even closer than that? Certainly we'll be continuing to watch that indicator. It's probably the number one recession reading out there. Better than the SARM rule, better than any of these other things. Treasuries, well, they did okay, and then they didn't do so well. This is to be expected. Again, treasuries are based on yield curves, expectations in the future. For treasuries to really nail like a 110, we're going to have to go into some very bad data. So, of course, you'll be watching data if you're watching the treasuries. I would say it's a technical high for now. And then if you're holding it for a 12 to 18 month, I'm pretty sure 110 will eventually come through. XLF, we know that we need to watch financials. Now, they were down 2.9% on the session. That's not as bad as you would think. If you actually go to KRE here, it was only down 2.75. I cannot say that is a market that is freaking out. Now, I look a lot at debt, and all of the debt style market sectors were not dumping. And this means that at least, in my opinion of the market, and maybe even yours, we don't have a freak out here. We do not have a freak out in the US financial system, which I think is very important. Now, if we go over to my bonds indicator here, which we are going to track a lot, we know that that did drop through the floor and it's starting to recover. This will be an important factor. And of course, we'll need to watch this quite closely to see how it continues to react. Does it recover quickly? Does it continue to hold down? This can be a warning sign that bad things are impending. So of course, we will be continuing to watch that. Let's move over to copper. Significant weakness. Definitely didn't expect copper to take this low over here. And of course, that is a trade that I ended up dropping over the last 24 hours. I had a nice little buy in here. And at one point, it was looking all right. We were up about 1-to-1 in terms of ratio to stop loss, but then dropped it during the session. So obviously, you win some, you lose some. Semiconductors doing fantastic over the last 24 hours off that buy, but this one here, not so good. Is there a replication trade in there? Absolutely. So for now, what do we need? Well, we're going to have to get a 425 plus out of copper to really show that this market is turning. So we can move that back up. And that's just how it is. Copper is showing weakness in the economies, so certainly worthwhile watching it. We'll keep following it on the channel. The US dollar, it dropped off and it's continued to drop, recovered a little bit over the last 24 hours as yields started to pick up a little smidgen, which we'll look at in a moment. And you'll notice here, we're not really interested in too much shorting until it gets back up to 103.80. So I'd say watching for now with the dollar, still think it's overall weak. But yeah, waiting for it to find some kind of mean reversion, like hitting this 20 moving average or maybe something else. On to yields quickly. I just want to mention here, yields have bounced. So you can see our line down here where we suspected they may bounce. Now back up to 3.96 on the 2-year. And obviously the gap is widening between the 2 and the 10 after hitting the uninversion, inverted commas. And then we've got a 3.85 here on the 10. So certainly not something I'd be necessarily super concerned about. And this is to be expected. We saw massive changes to the yield curve. Now the market's trying to figure out, well, what's going on realistically. Let's move over to gold. Still holding very strong. We still maintain very strong gold. Big bears, someone that was bearish up here. We mentioned there could have been a bear sell around that point. well, they would have done okay pushing it back down, but we held the most important zone of 23.57. We didn't need to force into 23.20, which remember is the secondary extreme good buy zone. And gold, yeah, it's holding up nicely. I think still looking really strong. The weekly looked fantastic last week, and we're looking towards this thing making an all-time high. Still maintain $3,000. Like to see that in the next 12 to 14 months. Let's move over to silver. Big bounce. Now, this is where they were all connected. When silver bounced off this 2650, and it is nice to have really good zones. So congrats, guys. You have good zones. And this is a 2650. We hit it live, actually, during our live stream on the Monday Open, and it found an instant buy. And that actually sent the whole market, all the markets hit these zones at the same time. They all rallied up. We had the S&P hitting around that 200 anchored VWAP and, of course, fib zone. And then we had silver hitting this at the same point. Now, silver has found a little bit of a buyer. When we look at the smaller time frames, it's very difficult to say there's great structure there. So we'll wait and see with silver. Maybe we'll get a good day trade. At the moment, it's mostly just for silver bulls and people that are going to be positioning long. Now, I mentioned before, US oil is starting to look a bit better. It certainly is. It's playing with the day trade bull zone. A break above here should signify day trading strength. We're looking at around 77 a barrel on the supply at that point, and pullbacks into this structure to be met by bull demand. So oil is dangerously close to actually finding some buyers. And if you look at it on the weekly, you'll see this is an extremely good zone for oil. So like to see oil find buyers here. Daily looks good. Let's see if we can get another movement up through the session. HSI, Chinese market, pretty much the same as every other market. It held, considering what happened. It hasn't really bulled. 17,450. That'll be a day trade if it does occur. For now, it's just basically sitting in a very heavily traded zone. So it's finding some buying. I wouldn't say it's finding anything in particular that's interesting though. What about the Nikkei? The Nikkei actually came down to very good levels. So you'll notice that this is our most traded zone. We had that on our chart. We shared it over on X. I thought we'd find buying pressure between there and this low. We have. This is a super recovery, but at the same time, it could be a dead cat bounce. It's wiped out the capitulation low. It hasn't wiped out, of course, the 27% fall off. And pretty much during all of these events, you usually expect some extreme pullbacks to get liquidity as well. So where is that? Well, I think we'll have to use the US markets. This one's not going to be easy to read. Let's move over to the next chart then, which is semiconductors. Now, this has to be the most important chart. We've been going on and on and on about it. We talked about it a lot on Friday's close because we know that there were dark pool activity trades coming through. We've seen plenty of trades buying stocks in here and in here. And I will report over the next 24 hours, I'd expect semiconductors to be getting a bit of activity on them. We're looking for dark pool trades to continue to find huge moves in here. We held the 200. We went to 198 during the open, just before in the pre-open. And this is why having those futures trading actions can be good. And then we ended up rallying up straight on that open. This was certainly sinking with silver and everything else. So very nice hold. Not that much to go off in terms of structure yet. If you go down to the smaller timeframes, you'll see it just went boom. It's oversold on most of my indicators. But at this point, you're really just looking for things like this gap fill. So basically up to 230, and then we'll see what happens next. We need more structure. Again, indices tend to be leading here. So semiconductors were looking nice. Nvidia opened up super low down in the 91s, obviously filled the gap of 95, which a lot of people thought couldn't happen. We had a 75 fib, which is an extremely low investment grade style level. I do like that level usually if you're going to try to buy a position and hold it. And I just want to reiterate this. Let's have a look at how much Nvidia is down. It is down 35.5%. That is a technical bear market after 20%. It is absolutely in one of its biggest falls that we've ever seen. Of course, we have seen 50% before, which recovered back in 2018. Also a point where the VIX freaked out and went crazy. And we did see some nice buying. So volume, of course, on the increase here over the last couple of sessions. Dark pool activity again coming through on this particular stock. And this may be a temporary low. Obviously, things like gap fills, 107.49. That's what people will be gunning for over the next 24 hours. They're going to try to rally this thing, I would think, up into these levels. That just makes sense here. Tesla, beautiful level, guys. I mean, this was a fantastic level. I thought 188 might have been what we get. We end up getting 184, 185. Certainly right where we saw those huge trades last time. We know someone defended in here and bought in here. So really, as it hit into that zone, there was probably going to be a buyer. These markets all sync together. Remember, pre-market, we saw it lower, so that's why it bought up. These can be all seen as just the beginning. You could have stops underneath these lows and say that's the low, that's how it's going to be. It's certainly a trading style in itself. We did see some other markets such as Crowd, which has of course been getting absolutely hammered, finding a nice green bar as well, possibly putting in the low after falling. How much is that now? I think that stock fell 50%. So you can see how fast things can get wiped out. That's certainly that's the first good green candle we've seen on that stock, by the way. Then we have Apple, another one that recovered off these lows, suggesting that maybe the selling is over. Head and shoulders pattern, not quite completing, but you never expect that on the negative side. And yeah, again, some strength coming in here. Clearly, funds do want to purchase these stocks, and they've tried to get them in. Is this a dead cat bounce? Well, I still look at that S&P 500 and I like what I see in terms of the structure. Now let's look at the indices though. This is where usually during high VIX periods, 25 plus, you really want to be looking at the market. That's a super hit. That is a super hit. Now, yes, I know it went lower than my most traded zone. I thought the 61.8 might hold around 2100, but this area here is a banger level. 2040, what a zone, absolute fantastic zone. And we saw it hold up through the session. Now, of course, Fundstrat's Tom Lee, he's bullish on this. He loves this level. But I'm sure, well, he loves it up here, but he loves it everywhere. But realistically, this is a key zone. This is a huge zone for traders and investors alike. And we did start to see some recovery signs. Again, we put in some changes of trend. We've done that for the first time through this whole pullback. So if you're thinking about it, there was really no buy sign, no buy sign, no buy sign, no buy sign, no buy sign till there. So we actually haven't seen a buy zone till exactly on 2040, exactly on that zone. So yeah, clearly something trying to stop the freight train, some life in this market here. US Dow, okay, back into the most traded zone here. It doesn't even look like there was a flash crash on the markets when you look at the Dow. What a boring pair. Let's move over to the NASDAQ, super level. Bull zone switch at 17,863, again pointing towards gap fill. This market's trying to do it as we're recording here. Sneaky thing. And we're still going to be using the S&P 500 levels, but I could see it kind of going like this and then maybe like that. So this is kind of the way I'm looking at it. There's a great trend line on the NASDAQ. I encourage you to put it on the charts. Have a look at that. We'll get some other VWAPs and some other things on there. Watch out the 18,520 level in terms of bulls getting back in there. We've got gap fills, of course, on things like NVIDIA and stuff to the upside. That could be where weakness comes in. And all of that's going to sink into this spot. So do I expect further bullish action? Yeah, I kind of expect it to be up from the previous session. And then will we then see weakness? Inherently, when you do have these huge rallies off, you do get a little bit of weakness at some point. Sometimes it just V's and goes off. Generally, it does find some weakness. Let's move over to Bitcoin. Fantastic level. We loved this the whole way, and it did find the buy. Very difficult to trade because if you did trade, you might have bought it here and put a stop below here. Well, you got liquidated. The one that was probably more safe, and I'll have a look at that in a moment, was Ethereum. But yeah, fantastic level. Certainly a key zone. Wiped a lot of people. Downward trend lines also holding. If some people probably have things like this and stuff drawn on their charts, whatever, it doesn't matter. The main point is that the market did actually find some recovery. And again, it's found some signs of life in terms of moving around. So some good stuff there. Ethereum was probably even better level. Look at the reactions here. Wick, 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 wick. No stop loss hunt either, which was nice. So Ethereum finding again a wick purchase off this major level, tapping into the most traded zone. I like that area. Again, it is mostly for the investor, mostly for the position-based buyer. For the week ahead, guys, we still have a little bit of news. We've got, I think it's the interest rate decision today for Australia. Don't expect any interest rate hikes, that's for sure. If they do that, they're mad. But anyway, we'll see what happens. And then we have unemployment claims for the US at 8:30 on Thursday. So it's really down to the market having a tantrum. Will we have just, or have we just seen the low? Negative 8%. The expectation before a rate cut in some scenarios was negative 8%. Did we ever see a negative 10? No. Did we see a negative 8? Absolutely. We've seen it a couple of times. So that's where we're at. If you enjoyed today's video, please remember to subscribe. Check out our newsletter as well. We will be sending out a few as we've promised this week. So we'll be sending out a couple of those. So make sure to send your alerts and sign up totally free down below. Follow us on X if you're interested in finding out more about replication style trades during these volatile times. Check out our website, fxevolution.com. And don't forget the sponsor of today's video, which is Tiger Brokers. The link's in the description. Check them out. For the Australian viewers out there, you get some extra bonuses. There are other bonuses as well for different members around the world. And I just want to say a big thank you for watching. We made history for the channel anyway during the live stream. And I'd like to think that we gave away some great information and you guys found some fantastic levels. Thanks very much and bye for now.